Thank you for joining us in this presentation where we will be looking at how does one make money when investing in the JSE listed shares or ETFs. This presentation will be of great benefit to those who want to create wealth slowly because creation of wealth requires patience, discipline and consistency. Paul says, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Before we delve into much detail, it is important to think about this. When any person or any investor put their money in any opportunity, the sole purpose is to get profit or to get some financial gain, right? So what is profit? Profit is what you get if you have sold something at a higher price than the price that it has costed you to actually produce or to make it, right? So now let's look at Sasol share. We can see that over time, Sasol share has fluctuated and it actually declined. Suppose Mr. X bought Sasol at 30 rands. That means it has costed Mr. X 30 rands and he sold it at 150 rands. That's the price that Mr. X is selling the Sasol share price at, right? So the difference between the price and the cost will give us 120. So we can see that the price is greater than the cost. So, and that's why we get a profit of 120. So in percentage term, it is about 400%, right? So of course, this profit will be subject to capital gains and there will be some fees that an investor has to pay when selling the share, and those fees can vary depending also on the stockbroker that one is using. So now when we look at a loss, that means in this case the cost to produce or to make something is actually greater than the price that you're going to sell that particular item. In this we'll also look at Sasol in this case. Supposedly someone bought Sasol at 500 rands, right? And when they bought Sasol at 500 rands, they actually sold it at 200 rands, right? When they sold it at 200 rands, so we can see that the cost is greater than the price. We can immediately see that that is actually a loss. So the loss there is 300 rands, which is 60% loss. So now, how owning shares and ETF generate money for the investor? Firstly, we'll look at the dividends. So when a company is operating, it will make profits and those profits are distributed among the shareholders. So if you own a share, that means you are a shareholder. So they will be distributed to the shareholders. And the risk that is there is that if the company is no longer, if the company is running at a loss or is not making a profit, that means you will not be able to get the dividends. And with time, depending on the profitability of that company or the profits that that company is making, the dividends can actually decline with time. And another way that we'll look at is share or stock price increases or appreciation. In this case, as we have seen with Sasol, we can see that the price of a share increases. So if you have bought it at 30 rands, now it has increased to 150. So there's been an increase in the share price of that particular company, right? So the major risks that are there is that when the supply is greater than demand, the share or stock price can actually decrease. And those those risks should actually not deter new investors from investing. And this is what Dennis had to say to you if you're afraid of investing because of fear of losing money. Dennis says life is inherently risky. There's only one big risk you should avoid at all costs, and that is the risk of doing nothing. So now, what does it mean to own a share or ETF? We have actually covered this in the previous presentation, but it is important to recap on this so that we can understand how do dividends and share price appreciation works. So in this case, when you own a share of a company, you automatically become a shareholder, right? If you bought that share, the share of any of those companies, you will actually become the shareholder, and you are entitled to any benefits from dividends or price appreciation that that company will actually generate, right? But now we've made a comparison with, or this is not actually a comparison, but we can also look at the Satrix Top 40. The Satrix Top 40 is an exchange traded fund, it's an ETF, right? So inside this top 40 unit or basket, we can see that there are different companies, and the companies that are here actually constitute, these top companies actually constitute about 65% in the top 40, right? So these companies here, so these companies here, you actually do not own them when you have bought an ETF, but you get the benefits of their dividends and the price appreciation, right? So you do not own the underlying assets. As you know, the price of the top 40, Satrix top 40, is about 60 or 50 rands, somewhere between 50 to 60 rands. And you can see that there's NASPA's there, but NASPA is above 3,000. The share price of NASPA is about 3,000, right? So when you buy these, you actually get an exposure to those 40 biggest company in the JSE, but you actually do not own them. But you get the benefits of the same benefits that you would have got if you were owning a single stock. But of course, that introduces some diversification when you own an ETF. So now, without wasting much time, let's look at dividends and the frequency of payment. So, for example, supposedly you own a share of NASPAS. We know that NASPAS at this current moment pays dividends of about 0.19% and only pay dividend once, right? So if you have bought the Satrix Top 40, that means you'll be getting dividends on a quarterly basis, and the dividend yield is about 3.1%, right? So the major risk here is that when you have bought one stock, right, when you have bought one stock, the company can actually run into loss and might not be able to pay the dividends. That means you run the risk of not always having dividends. But if you have invested in an ETF like the Satrix Top 40, that means you will always get dividends, because the constituents that are inside the in that basket, right, there are losers and winners. Those companies that are not performing well, they will actually at some point be kicked out of the top 40, right? Even if there's a company that is within the top 40 that is not paying out dividends, but there should be one or two or three or more that are paying dividends. So you will always be getting some form of dividends. They might not actually be as high as you would get compared to owning a single stock. And that's the nature of ETFs, because in ETFs you get the average returns, or you get average of dividends, average returns in any case. So now this is where things get interesting, and this is where when you think about owning a single stock, it becomes actually juicy and interesting. And our example again is Sasol. So now, if you have bought Sasol 3 months ago, and you were about to, and you sell it today, that means your returns will be 77%, right? And let's remember that these returns are subject to CGT and also other costs as well. So the returns will be 77%, right? And as a sole shareholder who bought at this point, or who bought it at its bottom, you will actually be very proud, to be very proud of yourself, and maybe have more confidence on your ability to speculate on which company will do best, right? And you'll be a happy person, right? But now, what if we also look at Goldfields? We can see that if you bought Goldfields 3 months ago, we can see that if you were to sell it now, your returns will be more than 70%, right? And these are superior returns. These are very superior returns. That means if you own Goldfields, these are the returns that you would have got. And at this point, of course, you are very happy that you are a good investor and you are good at picking stocks. But what if you also picked something like Remigro, all right? Remigro over the last 3 months, its share price has declined by 36%, right? 36%, meaning that if you bought it 3 months ago and you were going to sell it now, that means you will have lost 36%. And those are really large losses. And I'm sure this will not make anyone happy. That's quite very sad, all right? And now you'll probably be doubting your ability to pick stocks. But this just shows us or just highlight to us that when you own a single stock, that you can get very superior, there can be large losses and there could be superior returns. But if you look at something like the Satrix Top 40, all those companies, Goldfields, we looked at it, and we also look at Sasol, we also look at Remigro, those companies are inside that Satrix Top 40 basket. But their returns are not in any way close to 71% that we saw at Goldfields, or close to the decline that we saw in Remigro. But the returns that you get here is 14.53%. Why is that? Because in that basket of the 240, you have winners and losers. And at the end of the day, what you get is average returns. That's what we get when we invest in ETFs, right? You get average returns because inside that bucket, there are losers and winners. But when you pick stocks here or individual stocks here, yes, you can get 71%, right? And you are being compensated for the risk of, or you are being compensated for the risk of actually investing in that one company. But in an ETF like the Satrix Top 40, you are actually taking very minimal risk. And I think the reason why the easy equity classify it as aggressive is because it is invested in equities generally, or most of it is in equities. But really the risk that you're taking really is low, and you can see that the returns are low. And it's not always the case that very high returns are always linked with taking very high risk. But as we can see here, when you own single stock, you actually are going to get superior returns than what you will get in an ETF like the Satrix Top 40 because it gives you average returns, right? And these companies here, they actually constitute about 65% to the Satrix Top 40. So finally, or now, if you're afraid of investing in shares, just get started and feel free to ask any questions in the comment section below. Remember that for first-time investors, it's always good to start investing in ETFs, and then with time, learn, read books. Watching this video will probably just give you some ideas, but reading books will always be one of the greatest way to learn more about investing. And remember that once you understand those processes as you go, that means you can actually gather knowledge and develop your own strategy. And there is a place of single stock in any portfolio, and we'll explore that in some other videos in the future. But otherwise, get started, and thank you.